And coming up on World Business Watch today, a hidden supply chain risk behind the AI boom. Rising geopolitical tensions are triggering a global helium shortage, a critical element used in semiconductor manufacturing, and that's raising concerns for chip makers and the broader tech rally. We will decode this and more on the show today. Stay tuned. Those were the top headlines at this hour, but let's get started with the fuel prices. Now, rising fuel prices, they're serving fresh tensions in the United States with clear signs of distress emerging in the restaurant sector. Gasoline prices have surged nearly 40% year on year to an average of $4.43 per gallon. In key markets like California, prices have crossed $6 per gallon. As fuel costs climb, discretionary spending is taking a hit, with dining out among the first to be hit. Analysts note that the $4 per gallon mark acts as a tipping point, beyond which restaurants' visits decline more sharply. Major U.S. restaurant chains are already reporting the impact. Wingstop saw an 8.7% drop in same-store sales growth, while Domino's posted weaker than expected growth. Even relatively resilient players like Chipotle reported marginal growth and have flagged a cautious outlook. Data suggests that at fuel prices at around $4.20, restaurant traffic declines by about 1.5%. For a typical outlet, a $1 increase in fuel prices can translate into roughly $22,000 in annual lost sales. As a result, more companies are turning to aggressive discounting and value menus to retain customers. The broader outlook for the sector is turning increasingly cautious. Analysts are cutting profit forecasts with nearly twice as many downgrades as upgrades recorded in April. Investor sentiment that has also weakened, with the U.S. restaurant index falling 5% since the conflict began, wiping out over $40 billion in market value. The next key signal will come from McDonald's earnings, which could offer further insight into how deeply the rising fuel costs are reshaping consumer behavior.